The Philippine economy just hit a wall. First quarter GDP growth collapsed to 2.8%, completely missing the government's target and sending a wave of panic through the local markets. You can see the damage clearly in the property sector. Ayala Land, the biggest developer in the country, just reported a 22% drop in first quarter net income. The environment got so rough that they slashed their 2026 capital expenditures by tens of billions of pesos. This chart shows exactly why you can't paint the whole market with the same brush. While Ayala Land is pulling back, across town, Robinson's Land Corporation just posted a 9% profit surge, pulling in 4.4 billion pesos in that exact same brutal quarter. The problem right now is that most retail investors are trading the headlines. They see the scary GDP numbers and dump their entire portfolios, instead of looking closely at individual balance sheets. Following the herd during a macroeconomic panic guarantees you will miss the specific companies that are quietly and steadily printing cash. Take a look at their top-line growth. First quarter revenues climbed 11%, hitting 12.28 billion pesos. Shielded from the housing slump, their recurring income backbone, malls, offices, and hotels, now makes up 85% of core earnings. They aren't relying on selling condos. And then there's a metric called the net gearing ratio. This measures how much of a company's operations are funded by debt versus its own equity. Robinson's Land is sitting on an exceptionally low ratio of just 9.64%. In a high-interest rate economy, that number is your survival rating. It proves that their current growth is being fueled by actual cash flow, not by taking on expensive, high-interest loans that eat away at future profits. So while their competitors are freezing projects and hoarding cash to weather the storm, Robinson's Land is out there aggressively expanding their real estate footprint. By relying on diverse, reliable rent checks rather than unpredictable property sales, they have built an armor-plated balance sheet that thrives even when the broader property sector stalls. That clean balance sheet is funding a massive regional takeover. Down south, they recently acquired the 9-hectare Victoria Plaza complex in Davao City, turning a historic site into a sprawling mixed-use estate. Over in Rizal, they are pushing heavily into logistics infrastructure. They are building a massive new shop-wise big box development at Sierra Valley, combining heavy-duty warehouse scale with retail synergy. And to bypass the slow local residential market entirely, they have started directly marketing their high-end properties, like Hudson Place residences, straight to wealthy buyers in Singapore. All of these moves feed into what management calls Vision 52550. This document outlines their public roadmap to hit 25 billion pesos in net income by the company's 50th anniversary in 2030, aiming to drastically expand their mall, office, and logistics capacity. This brings us to the ultimate payoff for investors. Because they are generating so much predictable cash, Robinson's Land just declared a record-breaking dividend of 1 peso per share, representing a generous 36% payout ratio. Robinson's Land is systematically executing a decade-long master plan, essentially paying its shareholders to wait while other developers struggle just to reach the end of the year. To find opportunities in a volatile market, an investor has to block out the emotional market chatter. Moving past the panic requires a clinical approach to valuation, one that prioritizes the ledger over the loudspeaker. This is the logic of the Alpha Protocol, a strict requirement to evaluate a stock solely on cash flow and numbers, regardless of how the broader index is performing. Let's run a Blackout Ledger exercise for Robinson's Land. We cross out the terrifying GDP reports and the general property slump. Instead, we highlight the 85% recurring income stream, the low 9% debt load, and the 1 peso dividend payout. When fear dictates market prices, it creates a massive discount on the companies actually generating cash. Generational wealth is the byproduct of holding robust balance sheets when the rest of the market is paralyzed by headlines. So, looking at those numbers, are you buying Robinson's Land for the dividend right now, or are you waiting for a market pullback to